Hello. Last year saw Embark carry out two major acquisitions, the purchase of Alliance Trust Savings Advised business and Zurich's platform. We're here with Phil Smith, Embark's Chief Executive, to discuss what this means for advisors and the company's plans for the future. Hello, Phil.
Good morning, Dave.
How will advisors benefit from Embark getting bigger?
Well, first and foremost, it cements our scalability, it cements our financial strength, our ability to invest in keeping the platforms that we have relevant, live and forward-leading, and therefore able to match the evolutionary journey that advisors in the UK are going on. So that's really fundamental, service and right proposition. Underneath that, scale, if used appropriately, brings pricing advantage. As you're probably aware, we're already very disruptive with our core Embark platform, which is broadly used as an institutional play into a certain segment. And our plans for Zurich and the to-be advanced platform is very much to progressively improve the pricing point with added services. So we think stability will be there, quality will continue to improve, service won't be impacted, but they'll continue to trade with a very financially strong business due to that new scale.
So do you expect that your clients will see the cost of using Embark get cheaper?
Over time, yes, for legacy Zurich clients, and in contrast for Alliance Trust Savings clients who had a particularly sharp pricing proposition under the Alliance Trust brand, that will be maintained for those investors. As we've commented to yourselves in the past at the time we did the acquisition, treating customers fairly and maintaining so-called grandfathering of terms is quite important. And we have to stay relevant and we have to stay price sharp in what is still a very competitive market.
Mm-hmm. Some platforms have struggled in recent years with upgrading their technology. How are you going to make sure that the transition of Alliance Trust Savings advisors and Zurich advisors goes smoothly?
That's a great question. I think one can only do 3 or 4 things in reality. For us, first and foremost, not being the direct owners of proprietary technology, which, by the way, we thought was too much of a risky strategy for a business in this market. We are very close partners with our provider, FNZ. That collaboration and depth of involvement means that we can plan ahead for evolution of content and migration and upgrading. So that's number one, close alignment and good planning. Secondly, where platform migrations, upgrades and change tend to fail is not in the technology. Where they tend to fail is in the data preparation, the staging and the communications phases. And I'll not go through them today, but the kind of well-marketed failures that we've seen over the last couple of years, their root causes in those dimensions. So that's where we focus our effort before change. Again, if I may, just in the back end of 2019, we moved a very substantial book of business for just retirement from a GBST-based solution onto our FNZ kit over a weekend. It was many, many thousands of advice clients in complex drawdown situations, and we did not have a single murmur from that client base. And the reason that was successful was we data prepared well, we planned communications incredibly well, we dress rehearsed, and then we migrated in a downtime window. And you can do that whether it's 100 clients or 100,000 clients if you plan well. Now, that's not to say things are always going to be perfect, and we will see change under both the Alliance Trust transition and in the Zurich transition over time. But our fundamental driving goal is to protect consumers and to make sure their life is not disrupted. If you do that, the advisor's life is not disrupted. And it's that lens that we try to put on things. I think finally, in the kind of strain of things that you do, there are kind of 2 paths. So businesses that are struggling economically tend to defer ongoing development and maintenance until such time where they've gone 4 or 5 years and they have to do a massive upgrade. And that's where disruption really, really, really kicks in. The other track, and I think the smarter track, is that every year you're reinvesting and you're marginally improving your capability and your technology, and you don't have to go through those massive watershed changes. And that's definitely the path that we set out on several years ago and will continue to be on for the foreseeable future.
Mm-hmm. And how much change do you expect Alliance Trust Savings clients and advisors and Zurich's clients and advisors will see over the course of 2020?
I think in a access and service point of view, relatively small change. So I think it should be low in its disruption to them. I think in the proposition and capabilities they can access, I think there will be a positive and material change over time.
And looking across the wider industry, how many more platforms do you expect will be sold, bought up? How much more consolidation do you predict?
That's a very good question. So I don't have a magic crystal ball, but I think reality is that we'll see 2 or 3 more platforms change ownership over the next 18 months, would be my kind of rough finger in the wind. But I think that's driven more by businesses who have a different strategic impetus than a solely platform-based organisation, who may change their strategy and decide to come out of what is a intensely technology-based area. The interesting question, this is quite analogous to the SIP market 2 or 3 years ago, is you start to question where the buyers are going to come from. It's a very hard market to enter organically, as we've seen. I think we were the last scaled organic entrant. I don't think we'll see PE or private equity money coming flushing in to buy a position in the sector, albeit we did see that with the James Hay IFG transaction. So you look around the existing participants and run the rule over who may be a buyer. I don't think the list is very long.
Mm-hmm. So you expect that life companies, for example, will continue to leave the sector?
Not necessarily. I think businesses will either have a secondary reason to have a platform if they're a broader financial services operation. So they'll be distributing investment products, or they'll be gearing through banking capabilities and things like that. So there is a legitimate reason for larger institutions to have platform capability and reach for their manufactured liquidity or investment product. There are others where that's a little bit of a narrower track, where they don't have the capacity to continue to invest in all things, and the margins and relative risk of a platform business relative to other products will probably mean that they divest. Mm-hmm. Couldn't tell you who they may be, but that would be the rule of thumb I would put over it.
And will Embark be taking part in much of that consolidation?
I hope not. So, quite honestly, the ambition we have is to be a very, very large business over time, and we want to get there quickly but safely. Mm-hmm. We also have the capital backing. We have a wonderful shareholder roster now of long hold corporate investors. So should we want to participate, we definitely have the capacity to do that. But one has to be a little bit measured. Now, you never say never with these things. If the right opportunity at a killer price with the right risk profile and the right dynamics were to fall into our lap, then we've shown that we move and we act quickly and we do that safely. But I don't see it coming, certainly not in the next 18, 24 months.
Okay. Thank you, Phil. And thanks for watching. For more information on this and other topics, visit ftadvisor.com and tune in again soon.